Hello and welcome, traders, investors, and clients, to our Blackbook series of videos. Quite a few things have happened since our last update, more on the fundamental side than the technical side. So as usual, we will update you on both the technical and fundamental information in the markets that are most important to our traders and investors. Now let's get to the markets. Let's look at the gold market. Leading up to last Wednesday, it was building a nice base from the 1630s onwards. And then on Wednesday, right after the release of the FOMC minutes, the market suddenly tumbled. I will explain the FOMC minutes more in depth later on in the video. Intraday last Wednesday, the gold market went as low as 1613 and then reversed itself and moved higher into the overnight hours and into Thursday. I would like to state here that the support zones that we have continued to mention in our updates between 1624 and 1620 have held up well. And the 1600 psychological barrier looks very formidable even after this quick and deep sell-off the gold market has had. Now let's look at the silver market. Just like gold, last week it was building a nice little base from 3175 towards the 33s. Then right after the release of the FOMC minutes on Wednesday, it had a quick sell-off, moved intraday as low as the March lows. At one point it was slightly below that at 3109 or lower. We believe that as long as the low 31s, which is the support zones that we have discussed, continue to hold, it should be a strong market. Again, the 30 psychological barrier has not been tested on this downside movement as of yet. So if these support zones continue to hold, we think the 30 psychological barrier should be very strong. One more point that I'd like to stress is that in both markets, gold and silver, we would like to see a settlement or a close above their respective 200-day moving averages. As of the making of this video, for gold it's around 1703 and for silver it's around $33.42. If we get a settlement over these 200-day moving averages, it will only strengthen the upward movement in these markets and bring in fresh buying power. Now let's shift gears and look at the fundamental side of what took place last week. First, there was the release of the FOMC minutes. It is a regularly scheduled release, usually after 2 weeks from an FOMC meeting or a Federal Reserve meeting. The minutes, they detail what the Fed governors were thinking about the different sectors of the economy and their overall picture for the US economy. Why did the market sell off that aggressively after the release of these minutes? Because certain traders and investors, they took the information from these minutes as a confirmation of a very strong US economy, and therefore a almost non-existent chance for a QE3. At this point, I'd like to remind our viewers, traders, and investors that there was no new information in these minutes, and there was no major new data that required such a knee-jerk reaction to these minutes. So the important takeaway from this kind of market volatility is that it should only concern you if you're a day trader. But if you're a position trader or a swing trader, meaning you want to take advantage of a market movement over a certain time period or a certain trend, though it's concerning, it should not lead to a purely emotional play in the market. This is further evidenced by our next fundamental event that we want to update you on. In our last update, we talked about the release of the non-farm payroll number, which was released on April 6th. The number was a positive one, and it was said that we had created 120,000 jobs. The consensus was for a job number of between 200 to 205,000. This was also the weakest number in 5 months. Also remember that the number was released on Good Friday. Therefore, we couldn't see a major reaction to this number because most of the markets around the world were closed. The following Monday, after Easter, you probably noticed that the stock markets have sold off aggressively in response to the release of this jobs number. But the precious metals markets have been resilient and have bounced off of their lows from last week. This goes to show you that the people who reacted emotionally to the FOMC minutes had all of their reasonings reversed within a couple days because of a less than stellar jobs number. These same individuals are now probably screaming for an additional QE from our Fed. At this point, I would like to stress that we have always mentioned that the likelihood of another QE at the next Fed meeting is very small. and we are not getting into trades just simply based on the expectations of a QE3. I think everyone should be aware that this whole QE situation is a major speculative event, but should not be the sole reason that you get into a long metals position or wanting the price to go higher. I would like to mention that we are not super bullish the metals sector as of yet, simply because we need additional confirmation, both fundamentally and technically, to get into that frame of mind. We do believe that the metals are a range-bound market, and if you're not an emotional trader and you're willing to look at both the long and short side of the market, you could take advantage of a range-bound market, even though it could be frustrating at times. Now let's get to the bullionite moment. So what would a bullionite do with all this information? A bullionite should understand that there is a difference between a leading market and a reactionary market. What do I mean by that? If you look at the commodity sector, crude oil is a very important market, so much so that it's considered a leading market. What I mean by that is that leading markets like crude oil, many weeks before other markets begin to move, will give you hints to what other markets want to do. So you take those hints and apply them to reactionary markets like silver. Why do I call silver a reactionary market? Because silver tends to mirror movements in the crude oil and gold market. For the last couple months, crude oil has slowly but steadily continued to move higher with corrective price actions along the way. If crude oil begins to build a base just above $100 a barrel, and if it gets comfortable over that level, it may move higher. And if it gets a settlement or a close above $108 or $110 a barrel level, it could make a much more significant move higher, maybe into the 120 to 125 a barrel level. If that were to happen, you could see both the gold and silver market move higher along with it. So a bullionite will watch the crude oil market intently over the next couple weeks or months. And if it begins to break resistance levels, a bullionite will be ready to take advantage of the reactionary markets. If you have any questions or thoughts about the markets and information that I have shared, please don't hesitate to contact us.